Okay, so in this video, we're going to talk about the principal financial statements. And my claim is that the financial statements are intimately related with our accounting equation here. Okay, so we have the accounting equation written here. The main financial statement, you can say, is just the presentation of this equation. We call it the balance sheet. So just showing a list of all the assets, all your liabilities, and the balance of equity. We call that the balance sheet. So the balance sheet is going to be a point in time. It's going to be taken as of a particular date. So it's usually the end of the year. So it's going to be, let's say, 12/31, and then at the end of the year. So on the last day of the year, your your company has been transacting for the whole year, every day, even within the day, many transactions. But at the end of the year, and at each point, again, my claim has been that this balance is always going to be achieved. This symmetry between this left side and this right side, at every point in time after every transaction, this balance is holding true. And so the balance sheet is going to say, okay, we're going to uh, stop the transactions on this last day of the year, and we're going to see what the balances are for each of these, all your assets, all your liabilities and equity. And if my claim is that at every point in time this equation is balanced, we should expect that as of the last day of the year, it should also be balanced. So that's what the balance sheet is going to prove. Now, in order to get there, the assets are pretty straightforward, like cash. You're going to look at your bank account balance as of the last day of the year. It's going to have some dollar amount. You're going to have basically, how much you paid for land. All your assets is going to be pretty straightforward. Your liabilities, if you have a loan, you'll know what the balance is as of the end of the year. You'll know what we call accounts payable, how much you owe to the vendors of your business, which are kind of like short-term loans. You're gonna have all these balances. Now the equity is a little more uh, complicated. Now, on one hand, the common stock, this is going to be a pretty straightforward balance because you'll know how much stock you've issued uh, in your business. The other part of this, retained earnings. Okay, so remember, this is contributed capital, and that is in the form of common stock. That is kind of the instrument that a investor can use to contribute money to your business. But the retained earnings, remember, is your profit minus your dividends. So we have revenue minus expenses. This is your profit minus whatever dividends we paid. Now, in order to get this balance sheet, we need to know what the total balance is for this equity. And yes, we can get the contributed capital pretty easily, but there is some detail here that we need to kind of calculate. Okay, so this first part of it for retained earnings, and again, the goal is to get to the balance sheet for which we need our balances for the contributed capital and for our retained earnings. Okay, so a preliminary step to get to retained earnings is we want to first calculate the profit. Okay, so this is another financial statement, just the revenues minus expenses. Revenues minus expenses gives us what we call net income. So just this part here, this detail, we call the income statement. So this net income is basically your revenues minus expenses. So we have this number now. Now the next part of this is another financial statement where we take our net income and we combine it with how much we paid out in dividends. So the way it works, and this is called the statement of retained earnings. if we're looking at yearly financial statements, we have some balance of retained earnings from the beginning of the year. So we have some starting balance. Let's say it's $100. And let's say now we're going to basically see what happened with our revenues, expenses, and dividends in the period that we're looking at. So it could be this year. So let's say it's 2026. So in 2026, and so this starting balance is basically from the start of the business. So let's say this is like an old business. We started in 1900, all the way up to 2025. We've we have this balance that's kind of the accumulated balance for retained earnings here at the starting balance. Now we're going to see what happened in 2026. We're going to update it. So we're going to add this part here. We're going to add the profit. So we'll add the net income. Let's say we earned $20,000 of net income. But then we're also going to see how much we paid out in dividends. We also are going to now include this part. So again, this 20K is going to have come from here. We're going to have this income statement. It's going to show how much net income we generated. We're going to plug that into this statement of retained earnings. So this is kind of the first financial statement. Then we're going to move to this. And so let's say dividends. This is going to be a subtraction. Okay, we have this negative here. So this is going to be a reduction. So let's say we paid 19,000 in dividends. So we made a profit of 20K, but then we returned almost all of it to our shareholders. So now the ending balance for retained earnings is going to be 1,100 because we had a starting balance. There's a net change of 1,000, and so our ending balance is 1,100. Now, this net income and dividends is what happened within the year. So basically, this is on January 1. This stuff happened between January 1 through December 31. All the transactions that took place, it generated this much profit. We paid out this much dividend. And so this balance here is the December 31, and I guess in this case 2026 balance. So this ending balance, we're going to now plug in to our balance sheet. So again, we have assets equals liabilities plus our equity is our contributed capital plus our retained earnings. And now we've just calculated this retained earnings. So now we can complete this balance sheet. Now we have kind of all the pieces that we need to complete the balance sheet. So again, this equity section, we provided a little more detail. To get to this retained earnings, we first did the income statement. We then did the statement of retained earnings. That gave us the ending balance of retained earnings to be able to complete the balance sheet. Okay, so uh, the goal was eventually to get to this balance sheet. That's kind of the key thing. In order to do that, we did some sub calculations where we first found the net income. We combined that with our dividends to get what the ending balance of our retained earnings was. And then we plugged that in to our balance sheet to make it all balance. So I'm just gonna show you the very contrived textbook example, and then we'll look at a real balance sheet, or we'll look at the real financial statement. So again, we first start with the income statement. Okay, so we have our revenues and we have our expenses all listed here. So we see we generated this much in revenue, we had this much total expense, and so this 5,300 is our profit for this period of time. And in this case, we are just looking at a month. So the income statement is covering some period of time. It's all the inflows and outflows of revenues and expenses that happen during some period of time. So in this case, it's a month. You can have an income statement that's covering a year. You have an income statement that's covering a quarter. But we'll always specify some period of time. Then again, we're moving on to the statement of retained earnings. In this case, we had zero starting balance. So we can assume maybe that this business just started this year. Okay, maybe this is the first month of operation. So our starting balance for retained earnings is zero. We're adding in that $5,300 from the previous financial statement. This net income is what happened during this month. Okay. We also paid a dividend. You can see here that it's a subtraction. We're minusing. That's what these parentheses mean. It's a parentheses imply a negative number. So the balance at the end where we add the net income, we subtract what we paid out in dividends, the retained earnings balance, again, this is as of the end of whatever period this is. So this is the end of the month. We now have this balance as of a specific day. We saw what happened from the beginning of the month to the end of the month, and we now have this ending balance. And this ending balance is what we're going to use in our balance sheet. So now we have our balance sheet. Again, this is simply stating the accounting equation, assets equals liabilities plus equity. So we have all of our assets listed here and the total. So we have some cash. Accounts receivable is when you provide a service or you sell something to a customer and they haven't paid you cash yet. They owe you money. So this is kind of like a loan you have given to your customer. Okay, so this is not money you've borrowed. This is like money you've lent because you've done some service or you've sold something to a customer and they are going to pay you eventually. So this is kind of how much money you're owed. Okay, you're eventually going to collect this, but for now it's just held as this asset that we call accounts receivable. And then you have some office supplies and you have some land. You add it all up, we get 30,500, which again is this side of the equation. You have one liability called accounts payable. Um, and so we have that liability, which is here. And then we have some common stock that we issued. So this is the contributed capital. And then we have also retained earnings, right? And we just calculated this in that last financial statement called the statement of retained earnings. Again, this balance sheet is as of a specific date. It's not covering the month of November. It's just this balance as of the last day of the period. Okay, so um, because every day this balance, assets equals liabilities plus equity, is changing. The balances keep going up and down as we generate revenue, as we have expenses, as we buy assets, as we kind of bring in cash, as we borrow money. So this balance is constantly changing, but we're going to basically have a stop date. We're going to say, okay, stop it as of the end of the month, and let's see what the balances are as of this particular day. And that's what this balance sheet is showing. And of course, you can now see at the bottom here, your assets equals your liabilities of this 200 plus this total equity. And we can see that our accounting equation is balanced. There's one more key financial statement called the statement of cash flow. We're not going to cover this later, but just to introduce it, it's basically showing how much cash is moving in and out of your business. Now, as I mentioned, the accounts receivable, here's just a quick example. Um, you could have had some revenue generated, which is going to increase uh, your income statement, which is going to increase your statement, your retained earnings balance. But this revenue, if you generate it with a loan to the customer, they're not paying you yet, it's not generating any cash flow. Okay, so what we're trying to do with the statement of cash flows is just look at how much actual cash is going in and out of your business. And again, we're going to cover this later. This is actually kind of a little advanced to figure out how to do that. But we're just going to introduce it now. Okay, and so now let's just kind of end this with looking at the financial statements of a real company. So you can see here, this is Costco. Okay, so this is Costco. We're going to start with the income statement. So you can see here that they have multiple years presented. These are yearly income statements, so they're covering a in this case, 53 weeks. Okay, so this is how much Costco generated in revenue and net sales. This is like basically from the sale of all the stuff that they sell in their stores, the clothes, the food, and all that. And then they have membership fees. This is another source of revenue for them. So this is the total revenue. The merchandise cost is like how much they have to pay to buy the stuff that they're selling. And then this is everything else. This is like the corporate overhead, the rent that they pay for their buildings, the utilities, everything else. Um, and then there's some interest expense that they pay on their loans. And by the end of it, we get 6.2 billion. This is in billions. So $6.2 billion of profit. This is their net income at for this particular period of time. So remember this number, 6.29 billion. So the second statement that we talked about was the statement of retained earnings. Now, for a real company, they basically have a financial statement for all of the equity accounts. So that, remember, is contributed capital. So you can see common stock here, um, which is actually both of these two. And the details of this we're going to cover later. Um, but really, this column here is a statement of retained earnings that we see in the textbook. So let's just look at this column, okay? And you can see that there's multiple years. There's 2020 to 21, and then 21 to 22, and then 22 to 23. So if we just look at the 22 to 23, okay, we can see that we have a balance as of the beginning of the year, and it's not from January to December because they use a slightly different fiscal year. It's from end of August to basically the beginning of September. It's still a full year, but it's just offset a little bit. So we have some balance at the beginning of the year. We're adding in that net income. As we said, this is coming from that income statement that we saw, 6.29 billion. We then have dividends of 1.7 billion here. So you can see that they paid a dividend. And then they have this other form of dividend, again, which we're going to cover later in the class. But this, you can say that both of these two are dividends, essentially. So we're taking the starting balance, we're adding the net income, we're subtracting the dividends, and we're getting an ending balance for our retained earnings. So this column here is essentially the statement of retained earnings. And then, so remember this, 19.521 billion. Okay, and then finally we have Costco's balance sheet. So they have their assets kind of listed up here first. So they have, and we're going to learn about this format, but basically they're listing all their assets, cash, inventory, property. They have everything listed, and we see that we have a total here of 68.9 billion. Then they're listing their liabilities. So you can see that their total liabilities are 43 billion. And then the equity section. And that retained earnings balance we saw 19.521. It's now kind of translated into this balance sheet. And so when we get the total equity, we have 25 billion. When we add it with the liabilities here, we see that our accounting equation holds 68.994 assets equals liabilities plus equity. So um, what we're learning in the book, there's much more detail in a real company. They have more accounts, and the statements are formatted a little differently, but essentially the flow of this uh, that we're talking about from the income statement to the statement of retained earnings to the balance sheet, it is reflected in this real company, how they are presenting their financial statements.